The topic for today is financial statement analysis. But to begin, we are going to talk about the cash flow statement, and let alone we are going to talk about the ratio analysis. So financial statement analysis is divided into two. The first part, we are going to understand what is a cash flow statement. And then let alone, we are going to look at how we calculate ratios from the financial statements. And this is actually the climax in accounting. After you have prepared the income statement and the statement of financial position, the work of an accountant is now to determine or to analyze those particular statements so that you can be able to know what is the trend of the business. Is the business improving? Is the business deteriorating? And also to advise the management on the essential areas that they need to improve on. So financial statement analysis will actually pin out and identify the growth. It can identify the weaknesses and all that. So as I've said, this particular topic, we are going to focus on two things: the cash flow statement, though we are not going to prepare it. I've never seen that question being answered, being asked, sorry, but I've seen some questions that are touching on the cash flow statement. Once an accountant has prepared the income statement and through the income statement, the profit or loss for the business in that particular financial year has been stated, somebody might ask, does the profit maybe reflect or is it the same as the cash? Quite often, you have seen very many businesses struggling in terms of cash, but when you look at the financial statements, they are making profit. So somebody might ask, why can a business struggle, yet in the books it is indicated that it is making profit? The answer to that question is this: the profit that is indicated in the financial statements, part of that particular profit is actually on the accrual basis. And when I say on accrual basis, this, in the financial statements, we have captured the debtors. Remember, the debtors are customers who bought goods from your business, but they have not paid for that particular money. But because they bought those goods, when we are computing the sales, we normally include both the cash sales and the credit sales. All of them are normally combined together so that now we can get the figure for the sales. So the figure for the sales can be so high, but when you go to the actual books, you will find that very little from that particular sales has been received. And a huge amount of money is with the hands of the debtors. At that particular point, remember, when the sales is high, it simply means that the gross profit will be high. It simply means that the net profit will be high. So the business will report a very high net profit, but when you go to the bank account, the business does not have money. When you go to the cash box in the business does not have enough cash. Now, what is the problem now? The problem is this: some of the items that have been captured in the accounting statements as a money or as revenue, the money has not yet been received. On the same note, we are going to have what we call non-cash items, which are captured in the books of accounts. So a cash flow statement will only deal with the money that was received and the money that was paid out. It is not going to talk about any credit transaction, and it is also going to eliminate any non-cash item. A non-cash item, it is an item you consider as an income or you consider as an expense, yet there is no money that was received, yet there is no money that was paid out. And a good example of a non-cash item is depreciation. Every time we are calculating the net profit, under the expenses, we normally capture the depreciation of fixed assets. But if I ask you, does the organization spend any single amount to pay out for depreciation? The answer is no. If, for example, you have a table in your business, at the beginning of the year, you just approximate that this table of mine has got a value of 10,000. At the end of the year, you also approximate and you say that this particular table of mine, right now, it has a value of 8,500. So the difference between the value at the beginning, which is 10,000, and 8,500 at the end of the year, which is the closing balance, the difference between the two is the actual amount that the table has lost through depreciation, which is 1,500. But note, there is nobody that we paid the 1,500. It is captured as an expense, but no money moved out of the business organization. And therefore, that is an uncash item. We need to adjust the profit by not accommodating the depreciation because no cash was paid out. On the same note, when we talk about the sale of a fixed asset, when a fixed asset is sold, there is a point whereby we normally calculate the profit on a disposal or loss on disposal. Then, if it is profit, we normally add that particular profit to the gross profit. If it is loss, we normally take it as an expense. But now, under the cash flow statement, we don't consider that. We only consider the whole amount that was received. If it was 10,000 that was received from the sale of fixed asset, that was the cash that was received. But in the books of accounts, remember, we only capture the profit and loss. Maybe the profit was just maybe 1,500. So instead of capturing the total cash that was received, which is 10,000, we only capture the 1,500, which is the profit on the sale. So the adjustments are normally made in a statement we call the cash flow statement, so that we can be able to know what is the exact value or the exact cash that was received or that was paid out, leaving out any credit transaction in that particular financial year. So in the cash flow statement, you will find the following terms being applied. Number one, we have got the cash. Cash in cash flow statement simply means that the cash in hand, which is the cash that is in the business at any given point, and the cash at bank. That is what we mean by the cash in cash flow statement. Then there is what we call cash equivalent. A cash equivalent, it is any asset the business has or any investment the business has which can easily be converted into cash, or any asset that is actually the current asset that can be converted with cash almost immediately you need it. That is what we normally refer as the cash equivalent. They are very highly liquid. Highly liquid. When something it is liquid here, it simply means that it is very easy to convert it into cash. Like in your home, if you have an asset that if you want to sell it, it cannot take you even a day. That asset can be referred as a cash equivalent. Once you have it and you want cash from it, you can simply dispose it off and get money almost immediately. That is what we refer as the cash equivalent. Then we can look at the objective of cash flow statement. Number one is to ascertain the sources of cash from different activities. Under the cash flow statement, we normally get income and we normally spend money under three main activities. We normally get money from operating activities, or we can spend money on operating activities. We also have investing activities and financing activity. Each of these activities, you can either get money from them or spend money on them. We are going to look at them, but maybe I can explain them here. The operating activities are those activities that are normally undertaken in the business on the day-to-day basis or on a regular basis, especially things like the buying of stock, selling of goods, payment of taxes, sorry, not taxes, but salaries, and such kind of things that keeps on repeating themselves almost daily. So we are going to have them as operating activities. Investing activities, they normally rotate along the fixed assets. When you are buying a fixed asset, you are spending cash. When you are selling a fixed asset, you are receiving cash. So investing activities, it is either the sale of a fixed asset or the buying of a fixed asset. When money is received in cash flow statement, we normally say it is a cash inflow. Money coming in is normally referred as cash inflow. Money moving out is normally referred as a cash outflow. Lastly, we have got the financing activities. The financing activities are things like borrowing of a long-term loan. When a business borrows a long-term loan, it receives that money. Payment of those loans, it is still under the financing. Issuing additional shares, it is still under financing. So financing here simply means or talks about raising of additional funds or paying those long-term loans. So they are known as the financing. So another objective of the cash flow statements is to ascertain the uses by activities and also to ascertain the sources of finances and also the expenditures. Then to ascertain the uses by activities, the same case, and to ascertain the change in cash. To ascertain the change in cash, that is a change in cash from operating. Are we having a deficit or are we having a surplus? If from operating activity, we are spending more than what we are receiving, we are going to have a negative operating cash flow. The same case applies to investing. If we are investing more than what we are receiving from what we have invested, again, we are going to have a negative. Briefly, let us go through the purpose of cash flow statement. Number one, once you have prepared the cash flow statement, it can assist you in forecasting future cash flows and also assist the management in evaluating the decisions they have made. You can be able to know whether the policies you have put in place as a manager in the organization, whether it is actually of benefit or you need to review them to determine the ability of the firm to pay the stakeholders in terms of dividends and all that. Remember, I've said you can have profit, but you don't have cash. So a cash flow statement will give you an indication whether you are able to pay the dividends, because the dividends, they are paid in cash, and also whether you are supposed to or you are able to meet the obligations to the creditors. And also to show the relationship of net income of the business cash flow. As I said, you must also be now able to know what is the net profit versus the total cash that was received in that particular financial year. The importance of the cash flow statement, you'll find that most of them might be repeating from what we have discussed to identify the sources from where cash inflows have arisen within a particular period from the three that we have talked about. Also, it is useful for management so that they can be able to plan properly, and it shows the efficiency of the firm in generating the cash flows or cash, and reports the amount of cash used during the particular period, and reports the amount of cash received during the period through which various financing activities, e.g. the issue of shares, debentures, and all that. So the cash flow will give a very good indication whether you are receiving more than you are spending or you are spending more than what you are receiving, and the management can be able to adjust where necessary. When we talk about the component of cash flow statement, there are three. We talked about, or I've just mentioned, the cash flow from operating activities, and operating activities are regular activities. They normally take place in the business regularly, almost almost every day, but they cannot take long before they recur. And as captured here, include buying of stock, selling of stock, payment of salaries, those things that keeps on repeating themselves in the business, they are under the operating activities. So operating activities are accounting items which indicates the money a company brings in from ongoing regular business activities. Ongoing regular business activity. The key word here, they are regular, and you are given an example of them: cash received from customers, cash paid to suppliers, cash paid to employees. Those items are regularly undertaken in the business. Then we have got cash flow from investing activities. Cash flow from investing activities. As I said, the investing activities, they normally rotate along the fixed asset or the non-current asset. And therefore, we are going to see how much we are spending on acquiring the fixed assets and how much we are receiving from the sale of the fixed assets. So we have a good example here: proceeds on sale of non-current assets. Remember, non-current assets are the fixed assets. Cash used on acquisition of non-current assets and investment income received if you have invested in another company. A company can buy shares in another company and you receive dividends from that other company. It is still part of the investment. And again here, remember, in cash flow statement, we are going to talk about cash inflow and cash outflow. Like for example, if you sell a fixed asset, you are going to receive cash, therefore it will be a cash inflow. If you acquire a fixed asset, you are going to pay for it, and therefore it's going to be part of the cash outflow. And having noted that, maybe I can simply go and talk about the approaches used in preparing the cash flow statement. We normally have those three segments. We have cash flow from operating activities. If it is a receipt, it is then positive. If it is a payment, it is negative. You will find here a receipt from debtors, that is money coming in. It is normally a plus. Receipt from cash sales, you get, it is money received, it is a plus. Payment to suppliers, you are spending money, this is negative. Payment for expenses, it is negative. Therefore, you add this plus this, minus this, you get this, which is the net cash flow from operating activities. On the investing activities, you'll find proceeds on disposal of fixed assets. Disposal is simply sale. When you sell, money is received, so it is plus. Purchase of fixed asset, you are spending money. It is indicated here. So what you received minus what you spent, it is going to give you the net cash flow from investing activities, which you indicate here. Then you go to the financing activities. I said it is long-term loans and also the shares. If you obtain a loan, that is money coming in. That is an inflow, it is a plus. If you repay the loan, that is an outflow. Sometimes you can issue additional shares, so you are receiving money from the public, and you might pay the dividends to your shareholders, that is money outflow. Then you add that, you get this. So if you add the net cash flow from operating plus the net cash flow from investing plus the net cash flow from financing, you will get this, which is known as the net cash flow for that particular period. So what you also need to understand is these terminologies that are used here, because that is what they will ask you, but they will not ask you to prepare the cash flow statement itself. Then you need to also know that the cash flow statement is prepared using two approaches. Approach number one is what we call the direct method, and approach number two is known as the indirect method, and all that. I don't want to bother you with these very long stories. I want to go to the main area of the day, which is now the ratio analysis. The ratio analysis. Ratio analysis comprises of analysis of financial statements through calculating of the ratios. Once you have prepared the two commonly prepared statements, that is the income statement and the statement of financial position, you can go ahead and calculate the ratios from those statements, and then you can be able to know the profitability of the business. You can be able to know the liquidity of the business. Liquidity here, it is in terms of availability of cash when needed. We are also going to talk about the ability of the business to operate in many years to come. The ratios are going to reveal all those. So why should we compute the ratios? Why is it important for any business organization to compute the ratios? Number one is to evaluate the efficiency of assets to generate sales. How efficiently are we using our fixed assets to generate the sales revenue? That one can be known through the computation of the ratio, and a good example of that ratio is the ratio we normally call the turnover ratios. The ratios are also used in evaluating the ability of a firm to meet its short-term financial obligations when they fall due. Those are the liquidity ratios. The ability of the firm to pay the debts, the short-term debts within the stipulated time. If, for example, you are supposed to pay a supplier after 2 weeks, are we able to pay that particular supplier after 2 weeks? The liquidity ratio is going to reveal that. Also, to carry out industrial analysis, that is where you compare yourself with your equals in the industry. If you are a 5-star hotel, you compare yourself with the other 5-star hotel through the computation of ratios. You compute your ratio, and then you also compare the ratio of those competitors which you are in the same industry and also in the same level. ratios can be of help in that particular circumstance. For cross-sectional analysis within the firm, this is almost the same here. And also for trend analysis. Trend analysis, it simply means if I calculate the ratio in 2017, I go ahead and calculate the ratio in 2018, calculate the ratio in 2020. From that, I can be able to determine the trend. Maybe in 2017, the ratio was 1.5. 2018, it went to 1.8. 2020, it is a certain ratio. You can be able to know whether you are improving or deteriorating in your business, and then make the necessary adjustments where possible. And also to establish the extent to which the assets of the firm has been financed by capital or by debt, what we normally call the gearing. Through ratio analysis, you can be able to know, I have assets worth maybe 20 millions in the company. But of this, maybe 18 millions, they have been financed through debt, and only 2 millions we have financed using our money, which we normally refer as equity. If that is the trend, or if that is the reality in the business, then the business is on a very, very dangerous ground, because it simply means that you are paying out more interest to finance those particular assets than what actually you can be able. A good business should be a business where the total assets that the business has, a bigger percentage has been financed by the owners in terms of equity. But if you find the opposite is true, then the business will be suffering from solvency or insolvency, or they will be facing the insolvency where they are not able to continue operating in future. And also through ratios, you can be able to predict things like the bankruptcy of the business. Even though the ratios are very good and very important, they have some limitations. They have some setbacks or weaknesses. Number one, they ignore the size of the firm being compared. When you are doing cross-sectional analysis, in most cases, we normally consider firms of the same industry, and you might not consider other firms. And also, when we are comparing with our equals, you might find our equal in the industry who are actually the competitors, they might have diversified a case that might not be the same in our scenario. So even if we are comparing, in some cases, it might be hard for us to have that actual figure, because businesses, they are going to have a different kind of investment altogether. The effect on inflation. Ratio analysis does not consider inflation. If we calculated the ratio in the year 2017 when the inflation was very low, and then we calculated the ratio right now, 2020, when the inflation is very high, you might find that we are operating below what we registered in 2017, but it is as a result of the inflation which has affected that, but the ratio analysis will not put that one into consideration. Will not put that one into consideration. Also, it also focuses on quantitative aspects. Ratios will only focus on calculations only. Anything that cannot be expressed in terms of numbers cannot actually be calculated using the ratio analysis. Then they are only computed in one particular time in a year. Maybe we can compute them yearly. If it is yearly, in between here, we might have done very well, but at the end, we fail. But the ratio will just generalize for the whole year. It will not consider that. Also, in case a firm is a monopolistic or a monopoly, then you will find that it will not have the equal on the other side to compare. And a good example is things like the Kenya Power. Ratios are very, very helpful in comparing with your competitors so that you can be able to know whether you are operating above them or below them. In case of monopoly, that one will not be the case. Then it uses historical data. Historical data here means that it uses information which has already passed, some of which might not repeat in future. So if we make decisions using the historical data or the information or the data which has already happened, you might find that we might not get the correct picture because that particular scenario might not happen again in future, though we based our decisions on the same. Having said that, we can now move to another area. I think there is another one, computation and interpretation. On computation and interpretation, it has a weakness in the sense that the way I might interpret it is not the same way maybe Martins is going to interpret it. We don't have one common standard that is accepted globally on how we should compute and compare and evaluate those particular ratios. So in one way or another, it is subjective. In one way or another, it is subjective, meaning that it does not consider the aspect whereby we should have a common standard, where we should have a common standard in interpreting them. So I can compute them and say the organization is doing very well. Person X computes them and says it is not doing very well, and therefore there is no uniformity. And also it suffers some setbacks because of different accounting policies. When firms are operating in different industry or in the same industry, they might or they might not have the same policies or accounting kind of regulation, and therefore you will find them reporting differently. And also on this case, it can be on the accounting year. Some organization, they can operate for 12 months and they call that one the financial year. Others might operate for 6 months and they call that one financial year. So comparing those two, one was for 12 months and the other one for 6 months, it might be a challenge because they are not having the same accounting policies. Now, this is the area I wanted us to focus more, which is on categories of financial ratios. They are actually grouped into 4. We have the liquidity ratios, we have the leverage ratios or the gearing ratios, we have efficiency ratios, profitability ratios, and the market value ratios. So the first 4 are commonly applicable. The liquidity ratios. These ratios are normally used in getting or confirming the ability of a business to repay short-term and long-term obligations. The liquidity ratios, in short, they normally measure the ability of the firm to have cash, the ability of the firm to convert its assets into cash, and therefore able to meet the financial obligations or the financial debts when they fall due. These ratios are 3 in number, but the commonly used or the commonly asked ratio are the current ratio and the acid test or quick ratio. The common ratio and the acid test or quick ratio. As we look at these ratios, we shall be doing some calculations here and there using our past papers. I want you to have a look at the November 2019 paper, section B, question 3. Section B, that is on question 3. Once you are there, you can let me know. Are you there?
Question what, Mwalimu?
Question 3. Question 3 is on section B.
Okay. Karonga Limited.
Yes, Karonga Limited, yeah. Okay. The others, are you there? those who have the past papers with them. So I want to use that particular question so that I can be able to calculate the liquidity ratios, that is the current ratio and the acid test or quick ratio, using that particular question as our example. So we are supposed to calculate, or the question reads, the following information relates to Karonga Limited for the years ended 31st December, that is 31st December of 2017 and 31st December of 2018. And we are given the values for those 2 years. We are given the total assets, 22,800 for 2017, 2018 is 25,400. But I want to go direct to the question where we are told for the year ended 31st December. So we are talking about 31st December 2018. For the year ended 31st December 2018, we calculate those ratios. But the ratios that I'm interested with are those ratios that fall under the liquidity. Those ratios that fall under the liquidity. So the first one, it is the current ratio. The current ratio, which is normally given by current assets over current liabilities. Current ratio is given by the current assets over current liabilities. So for the year 2018, are you able to locate what were the totals for the current assets? Current assets, they amounted to how much?
7,440.
7,440. Then we divide by the current liabilities, which amounted to how much?
4,160.
4,160. If you divide that, what do you get? One point
1.788.
1.78.
Yeah, 88.
Okay, let me call it 1.789. Or it is not the case?
No.
Let me lab it then.
8884.
Let me just one decimal place, I can call it 1.8. 1.8 is to 1. We normally put it in ratio form. Once you calculate it, it's actually a ratio. The answer you get, you put it is to 1. This is now the current ratio. That is the current ratio. And from this ratio, you can say whether the business is doing well or it's doing badly in terms of liquidity. Note, liquidity is the ability of the business to generate cash to pay the liabilities. Once you find the figure is above 1, it simply means that the current assets are more than the current liabilities. If the figure is over 1, that is 1 point something or anything to do above 1, then the business is okay, meaning that the current assets are enough to pay the current liabilities and the business is able to remain with some. Then I want us, the question was not asking that, but I want us to use the same and calculate what we call the quick ratio.
Mwalimu, explain why you put it 1.8 is to 1.
Because it is a ratio. You know, a ratio should be in form of A is to B. The ratio should
be. So why 1?
1, because 1 will not have any effect. Actually, if we put maybe 2:3 or 2:1.5, remember this is the same as 2/1.5, which will have an effect. But when you calculate this and this, it simply means if all the assets are used to pay all these current liabilities, C1 in one itenda, so what we are going to remain in the business is 0.8. Are you, am I clear on that?
It's a bit deep, but can we assume, so whatever you get, you just say is to 1?
Yes, yes. Whatever answer you get,
Okay.
you put is to 1. Is to 1. Actually, it is to 1. So that it is in ratio form. If we just write 1.8, it is not in ratio form, and we are talking about the current ratio. So our answer should be in form of a ratio. Our answer should be in form of a ratio. Okay, thank you. The quick ratio is also known as the acid test. Is also known as the acid test ratio, and it is given by the formula, the current assets minus stock, which is the same as inventory, and then we divide by the current liabilities. Current assets, we minus stock or inventory, then we divide by the current liabilities. The key thing you should remember here, we normally minus, remember stock or inventory, it is part of the current assets. But people normally argue it this way. One, a current asset, it is supposed to be that asset that can be converted into cash within the financial year. It is not an asset that can be in the business for more than one financial year. Any asset that can be converted into cash before the 12 months of the financial year ends, it is normally referred as a current asset. But people normally argue that some stock items, they can be in the business for more than one financial year. And if some of them can be in the business for more than one financial year, then this inventory should not be considered as a current asset. So we normally get the current assets, then we minus the portion of inventory, so that now we can remain with those current assets which are easily converted into cash, and then we divide by the current liabilities. For our question here, if you were to calculate that, the current assets we had, they were 7440. 7440 minus, what is the figure for inventory? The figure for inventory is
1680.
1680, and then we divide by the figure for the current liabilities, which is 4160. What do you get there?
1.385.
1.38. 1.38, which is the same as 1.4. You also put it is to 1 because it is also a ratio. 1.4 is to 1 is a ratio. So that we can get out of that, I want us to do another question, which is June 2017. Have a look at June 2017 paper. June 2017, question 4. June 2017, question 4.
Mwalimu,
Yes.
for the November paper,
Yes.
where you're told to calculate average total assets,
Yes.
are you combining the 2 years and dividing by 2?
Yes. Actually, we are coming to that when we go to the efficiency ratios.
Okay, all right.
I go back there. Are you there for question 4? Question 4 for this
Yes.
year. Okay. I want you to have a look at that question, where you are told the following information was extracted from the final accounts of Sahara Limited and Kalahari Limited for the year ended 30th September 2015. You are given the sales, the cost of sales, operating profit, then we have got the interest expense and all that. Now we are told we calculate the acid test ratio, but I want us also to calculate the current ratio. So it is very simple in that case. You only need to know the total current assets, all the total current assets, and we also get the current liabilities for both. So we have Sahara, and the other one is Kalahari. Yeah? The other one is Kalahari. So I want you to do this. For the current assets, we know what falls under the current assets. Sahara, you add the inventory, debtors, cash at bank. Those are the assets that we have. So you add, for Sahara, we have 100,000 plus 46,000 plus 40,000. It gives us a total of how much? Is it
186.
186,000? What about for Kalahari? The assets are how much? 87,000, 42,000, 44,000.
173.
173,000. Talk about the current liabilities. For the two, 33,000 plus 187,000 for Sahara. Oh, sorry. The long-term liabilities, the current liabilities we are given there. They are just 98,000 for Sahara and 108,000 for Kalahari. And then maybe I can include this inventory for the case of the quick ratio. The inventory for Sahara is 100,000. And for the other one is 87,000. So if we were to get the current ratio, which is, we know it is current assets over current liabilities, would be equal to, for Sahara, the current assets are 186,000 over the current liabilities, which is 98,000. For the other one, 1.8, eh?
Yeah, 1.89, which is 1.9.
Is to 1. What about for Kalahari? The current assets are 173,000 over current liabilities, which is 180,000. What do you get?
1.6.
1.6 is to 1. 1.6 is to 1. Then if we are supposed to calculate the quick ratio, if we are supposed to calculate the quick ratio, which we know it is current assets minus inventory over current liabilities. For this case, the Sahara, we had 186,000 worth of current assets minus the inventory, which is 100,000 over the current liabilities, which is 98,000. You do the same for the Kalahari, which is 173 minus the stock, which is actually 87,000 over the current liabilities, which is 108,000. What do you get?
0.9.
0.9. The other one?
0.8. That is 0.79.
Just one. Those, or that is how we normally calculate the current ratio. And a good ratio, a good liquidity ratio, it is a ratio that is above 1. Like in this case, these companies are struggling financially when we use the current ratio. If we use the current ratio to evaluate the performance, these companies are not doing very well, because it simply means that the assets that is the current assets are not enough to pay the current liabilities. So the companies are struggling in one way or another. But when we talk about the current ratio, you can be able to see they are doing well. But when we minus stock from the current assets, whatever remains, they are not enough to pay the liabilities. So we can go back to our notes and go to the next type of ratios. We call them the leverage ratios or the gearing ratios. So they measure the gearing ratios, they measure the amount of capital that has come from the shareholders who are the owners of the business versus what we have borrowed in form of capital. So it measures what we have invested as the owners and what we have borrowed in terms of capital or the share capital. And there are quite a number. The liquidity or the leverage ratios we have, number one is the debt ratio. And the debt ratio, it is the total assets. Total assets here, we mean both current assets and the long-term, both the current liabilities and the long-term liabilities. We add all of them to get the total liabilities over the total assets. Total liabilities over the total assets will give us what we call the debt ratio. And a good ratio, it is a ratio that is as small as possible in terms of debt. In this case, if the business is doing very well, you will find that this ratio should be 0. This should be 0 point something, so that whenever the denominator is more than the numerator, the answer will be 0 point. Therefore, if the assets are more than the liabilities, that means that the denominator is bigger than the numerator, then that ratio is going to be small. So a smaller debt ratio simply means that the business is doing very well, because it will simply mean that the assets are more than the liabilities. Then we have got what we call the debt equity ratio under the leverage ratio, which is actually total liabilities over shareholders' equity. Shareholders' equity is actually the share capital, share capital plus the retained earnings. Let us see whether we have got such kind of a question. The same question that we have just handled right now. The same question that we have just handled right now, Roman 5 was asking about the debt equity ratio. Debt equity ratio, which we have said it is the total liabilities over shareholders' equity. Shareholders' equity. So the last item you can be able to see down there, it is the shareholders' fund. Shareholders' fund. The shareholders' fund of 197 for Sahara and 157,000 for Kalahari. So you can be able to calculate that. So total liabilities, can you calculate for me the total liabilities, the current liabilities plus the long-term loan? So we know it's given by the total over shareholders in this case. Total assets simply means current assets plus current liabilities plus long-term liabilities. So can you add that figure 98,000 for current liabilities plus 33,000? What do you get?
31,000.
131,000, eh?
Yeah.
The 131,000 over the shareholders' equity of Sahara, which is 197,000. So what do you get there? This is for Sahara. Huh? It is going to be 0 point something. For Kalahari, the total liabilities, we don't have a long-term loan, but we have the current liabilities amounting to 108,000 over the shareholders fund, which is 157. So what do you get here?
0.7.
It is a ratio is to 1. And what about this one?
0.7 as well. So 0.68.
Okay, 0.7 is to 1. So those are the ratios. We can also calculate the debt ratio using the same question, which is given by the total liabilities over total assets. Total liabilities over total assets. Total liabilities we had calculated for Sahara, they were coming to 131. Total liabilities, they were coming to 131,000 over. Can you give me the figure for the total assets? Total assets, you add both the non-current plus the current assets. If you add all of them, the non-current are the fixed assets, 142,000 plus 100 plus 46 plus 40. What do you get?
$328.
328. So you can compute that. The other one, the total assets 92 plus 87 plus 42 plus 44.
$265.
You just compute the two and you are able to get that. You are able to get that. So there are still ratios you put is to 1. You put is to 1. I want us to go to the next category. The next category, which is on the efficiency ratios. Efficiency ratios. The efficiency ratios, they normally measure how well the organization is using the assets in generating revenue. How well you are using your assets in generating the revenue, that one will be measured by calculating what we call the efficiency ratio. In that, we have the following ratios. We have like the inventory turnover ratio, inventory turnover ratio, which is normally given by the cost of sales over average stock. The cost of sale over average stock, where average stock is given by opening stock plus closing stock, you divide by 2. Opening stock plus closing stock, you divide by 2, you get the average stock. That is what you indicate here. I hope you don't remember that cost of sales, if you are not given the figure at once, you can be able to determine it as the opening stock plus purchases minus closing stock. That is how you calculate the cost of sales. The opening stock plus purchases minus closing stock. Some question, maybe you can be given this and then they don't give you this. Let me see if you can be able to calculate that ratio here. From this question, we are given what? We are given the cost of sales up there. Sales, then cost of sales. Then the only inventory we are given is 1. So you divide that one by 2. No, when the inventory is actually 1, you don't divide that one. You just use it the way it is. If you have got one figure for inventory, you have not been given the opening, then you use that figure as the average stock. But when this question is there, they must give you the both of them. So in this case, let us see the cost of sales for for Sahara, the cost of sales is 258,000 over the average stock. In this case, we don't have the one, we only have one stock here. If you get it like this, what will be the case? What will be the ratio? This one will be 2.58. And this one is not a ratio now, it is a turnover. We normally write anything to do with the turnover, you write times. We normally write times. So when we talk about the inventory turnover ratio, we are simply talking about the number of times you are going to change the stock, the number of times you are going to replenish stock in your business in that particular period. So in this case, we are going to replenish 2.58 times in that particular financial year. So the more times you replenish the stock, the better for the business, the better for the business. So it's actually the cost of sales over the average stock. Then we have another one known as the asset turnover. The asset turnover. The asset turnover, in this case, it is given by the net sales. over average total assets. Average total assets. Average total assets. Average total assets is the same as stock for period 1 plus stock, not stock, but assets. Just a minute, sorry. Average total assets. They are actually total assets for period 1 plus assets for period 2. Then you divide by 2. And then you divide by 2. You can be given 2 periods. If we can go to our initial question, which was 2019, I think. This was 2019 November. The question that we were talking about of Karonga Limited. There's a question that was asking about the average total assets there. The average total assets, and we were given 2 periods. We were given 2017 and 2018. We were given the 2 periods. So if we want to get the average total assets, you just add the total assets for 2017 plus the assets for 2018, and then you divide by 2, and you will get the average total assets. In that case, the total assets for 2017, they were 22,800 plus the total assets for 2018, which is 25,400. This is 400, then you divide by 2. That one will give you the average total assets. That will give you the average total assets. How much is that? So you can be able to get as simple as that. Then another ratio that you can be asked in this one, it is the accounts receivable turnover. Yes?
Before you go far,
Yes.
you have calculated the average total assets.
To be?
So if you were to work out the asset turnover,
yes,
we have 2 net sales. We have 2 net assets there provided.
uh-huh.
I see we have calculated the average total assets by taking the one for 2017 and 2018 and dividing by 2.
Yes.
And I was just wondering on the net sales, because we have the net sales.
Do we have net sales, or they made a mistake? I can see in the net assets, huh? But I think it was
net assets, yes.
But I think that was a mistake. It was supposed to be net sales, because I want you to confirm that by, if you have 17,680, which is the net sales, and you minus 14,320. Can you confirm whether you are going to get the gross profit that 360?
Yes.
I think then that is a mistake. It is not supposed to be net assets, it's supposed to be net sales. Net sales minus cost of sales gives us the gross profit. If we are to calculate then the net, if we are calculating the asset turnover, then we know it's given by the net sales. So if, for example, we are calculating the asset turnover for 2017, it's going to be like that. The net, the average.
Okay.
Yes, actually there was a typographical error there. It was supposed to be the net sales, not net assets. Any other question?
No more. Thank you.
Okay. Anybody else with a question? Okay. We go to the accounts receivable turnover. The accounts receivable turnover, which is normally given by the credit sales. The credit sales over the debtors or average debtors over the average debtors. Just that, and then you are able to get that. Some question you can be given the sales, and then you are told that the sales comprised of maybe the credit of this amount and the cash of this amount. That portion that is on credit terms, you divide by the debtors of the business at that particular point, and then you get the accounts receivable turnover. And remember, whenever you find there is this word turnover, so the answer you get, it is times. It can be maybe 2.4 times. Accounts receivable turnover, it is going to indicate the number of times we are repaying, or we are receiving, actually not repaying, we are receiving money from the debtors in a year. How many times are we going to receive money from the debtors in a year? If we do that calculation, then it is going to give us the number of times. So turnover ratios, which are also known as the efficiency ratio, their answers are given in times. Those are the commonly used ratios. Under the efficiency. Today I want to make one request. I want to make a request that we finish our class early because I'm rushing somewhere before 8:30. I should be there. So I request that we end the class at that point, and then when we meet on Monday, we finish on the profitability ratios, as you tell me the areas that you want me to revisit, so that I can be able to revisit during that lesson. So can you accept my request?
Yes, Mwalimu.
Okay, now that we are embarking on a revision, which areas do you think we should start revising? Especially for those who are doing the CHRP in December.
Mwalimu,
Partnership account.
for me, it's suspense accounts.
You have an issue with the suspense account. So
Me too, I would like suspense to understand suspense.
So we are talking about the suspense. Suspense simply means we cover the part of errors.
Yes.
Yeah.
We cover the part of, or we visit the errors. Anybody with an area that he or she feels needs additional attention?
Partnership accounts.
Partnership accounts, huh?
Yes.
Okay.
NDR adjustments.
Sorry? NDR.
NDR adjustment. Hello?
Yes, I can hear you.
NDR adjustments.
Yes.
Depreciations.
Okay, I get you. I get you. NDR adjustments. How to do the depreciation. Any other area?
Mwalimu, you could also check the most common questions.
And then I revisit. Huh?
Yeah.
Okay.
Yeah.
Okay. Okay. Sawa. I will have a look at that, and maybe when we meet on Monday, I'll finish on that part on the profitability ratios, and also cover on the errors and the suspense account. If time will allow, we can go to the next part, but that is what I'm going to start with. Is it okay?